Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker dealer. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. While I'm sharing my screen, a quick note to anyone joining us for the first time. Will and I, we do this show in the mornings, so we could take questions from you if you have questions about the Market Chameleon tools, the data, the analytics. If you want to come on the show and ask your question live, we do provide a link to Zoom on that live chat on YouTube. So click on that link. It'll take you over to Zoom. Once you're logged into Zoom, click on raise your hand. You could ask your question after that. If you prefer to type your question, you can type it into that live chat box on YouTube. Will's watching it and he'll read back those questions. While we're waiting for more people to join us and for people, give them a chance to type in their questions, we'll start out taking a look at the pre-market report to see what's trading in pre-market hours, if we could get some insights on that, and then we'll move on to the questions. All right, so let's start out with the pre-market report. These are stocks that are trading in pre-market hours. I'm going to scroll down here first and take a look at these three different lists. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. As far as the count goes, it looks like 38 stocks are made our percentage gainers list, the ones that met our thresholds, and 176 stocks are on our percentage decliners list. So from that perspective, right now, we're looking like the trading in a pre-market hours is setting up with bearish sentiment. Let's go up here. And this is a calendar view of what's been going on, in a pre-market hours. Historically, today, August 18th, this is what's going on so far in the pre-market hours. We're still not open. These could change, but this is from a high level, what's going on in pre-market hours. And we have a breakdown here. There are 208 stocks so far that are trading higher than the previous day's close in the pre-market hours, 620 stocks trading lower. As far as the volume of shares, 130 million shares trading higher, and around 130 million shares trading lower. If we convert those shares to dollar value, because not every stock is the same price, we see that there is $544 million worth of stock trading on up volume versus $3.6 billion on down volume. So this also confirms that right now, the activity in the pre-market hours is looking pretty bearish. Let's come down here and take another view. We see that in this list, we have a lot of stocks in there that are either low cap stocks, ETFs, leverage products. It could be any security that's listed on a major US exchange. If it's trading at pre-market hours and it meets our predefined thresholds, it can make this list. And to narrow down the list to a smaller group of stocks, we can use the filters up here. And if you have a watch list, by the way, you create a watch list, you can filter by your watch list. I'm going to use this one, an ETF. And when you click on that, you get a drop-down menu with different ETFs to choose from. Let's select the SPY ETF. And when we select it, that list below will get filtered by stocks that are holdings in that ETF. So SPY, click on that. That's the S&P 500 ETF, and the list below got filtered by, the holdings in there, which are the S&P 500 constituents. And so far, we see 1 made our percentage gainers list, 27 on our decliners list. So also from that perspective, looks like, everywhere we check, the trading in the pre-market hours is setting up right now with some bearish sentiment, and those active traders are, trading down those stocks. So we've got a couple minutes in there. Well, if we have questions, I'll take them now.
Well, Sarush was mentioning that he feels like the bears have started to really come after this market a little bit. I'm wondering, has anything in the SPY, like a major ETF, has anything changed in the skew? Are people actually coming after the downside puts or anything?
Yes, let's take a look at that. I'm going to go to SPY. And a couple different ways we could try to measure the skew. But what I'm going to do is go here to the strategy benchmarks. And what this does is we're going to take a look at the risk reversal. All right. And the risk reversal is essentially comparing an out-of-the-money put to an out-of-the-money call. All right. So we're going 5% above and 5% below an at-the-money option. And we're saying, well, what is the relative premium of those options? So if the put starts to increase relative to the call, right? So we're going to take, or here's what we're doing. We're comparing buying an out-of-the-money call versus selling an out-of-the-money put, right? So we're buying the call and financing it with the put. So if the put premium is larger than the call premium, we should get a credit, right? Like this, right? So if you have $100 stock and the 105 put is $1 and the 95 put is $2, you're going to get $1 credit, right? And dollar credit is 1% of the stock price. Okay, so here we see right now that buying the call, and this is on a 1 month. This is a 1 month constant maturity. Buying the call, 5% out above, selling the put 5% below, you're getting a credit of 0.3%. So the put is skewed higher, right? The downside put is skewed higher than the call, but that could be normal, right? That could always be the case in SPY because there's probably a constant demand to protect your downside positions and buy right the upside. So we could compare that to history. How has that changed? So yesterday, it pretty much stayed the same. So on yesterday, if we continuously just look at those 5% around, from one day to the next, it didn't really change or not significantly enough. But if we look at the 52-week average, you were getting a credit of 0.2% versus now 0.3%. So the skew did lift a little bit, right? So that did lift a little bit. And here we see the chart. So this is the chart for the last year. Okay, so if we go all the way down here to August, right, of last year, we see that the skew got as high as negative 0.4% credit, right? 0.4% credit. We see that up here got in November, it got to almost even, where the call and the put were the same premium, right? So it would have been you wouldn't have been debited or credited. And here's the 52-week average, that red line. So we could see how it fluctuates, right? It does fluctuate up and down. Well, actually, this skew here seems it was even lower. Let me see if I could hover over. Is that 0.4% too? All right, so that's 0.4% too. So you can see here, right now, we're probably, a little bit below the average. Up here, we've been kind of cruising, right? So the skew looked more bullish relative to its history up here, since June, and now we're starting to come back in to the average a little bit below. Let's take a look at the longer term. So that's on a 1 month, right? That's a 1 month basis. If we go to, this is a 2 month, 60-day, looks the same. If we go to a 3 month option, it's right at its 52-week average. So from this perspective, if we're measuring the skew, it looks like, it went from being bullish to like closer to its 52-week average, a little bit below. I think you froze or I lost you.
Oh, you can't hear me?
Oh yeah, I hear you.
Yeah.
Okay. So that's from this perspective. We can look at it from a couple more perspective, like over here. Let's take a look at skew. So that's looking at a benchmark of, option premiums. Here, this is looking at a 25 delta skew. Okay, so this normalizes it to the implied volatility in the option. So it says, okay, if I ran a straight implied vol, right, through all the options, how's the 25 delta put compared to the 25 delta call? So it's subtracting the put IV from the call IV. And here you could see some kind of a similar situation where it was below the average, right? It was below the average here, and now it's climbing, to a more bear, a little bit more towards the bear side as we sell off, but not, not nearly as high as we've been historically. Okay, so that's another way to look at skew, depending on, which angle you want to analyze it from the relative premium perspective, the relative implied volatility perspective. These are different ways to look at it. You could also, let me see here. If you wanted to compare the smile of different expirations, you could do that from here. So let's take a look at, I'm going to let go of these and say, how does this here is the implied volatility smile, right, for August 21st expiration. So what it's doing is looking at the different strikes and saying, for this strike, this is the implied volatility. For this strike, this is the implied volatility. So you could see visually how steep the skew is, or how narrow or how flat, you get to visualize the slope of the skew, or the curvature of the skew. If you want to do by delta, you could switch it here. And now this is by delta. Okay, so you could do by delta, or you could do by strike. So by delta is telling you, here's the 25 delta, the 50 delta right at the money. You could see how fast it starts to climb based on delta, right? Now let's say I wanted to compare this August 21st to, let's say, I don't know, September 8th. So click on that. And now we see how the implied volatilities in the two different expirations compare to each other if we lined it up by deltas, right? So you can see here that at the money, September 8th is a little bit higher, right? So it is a little bit higher, and it looks like to the downside, the September 8th expiration here in yellow, to the downside, the implied volatility is steeper. It climbs faster. The slope goes up quicker. right? The curvature of it is going up much quicker. Now to the upside, as we climb, those look like in September, the further we go out, the implied volatilities are dropping off faster when compared to, remember, it's not by strike right now, we're comparing it by delta. And the August 21st is a little much flatter. So let's take a look at it by, what if we just compared strike versus strike, right? So one strike versus the other strike, we could do that too. So I'm going to do it by strike. So by strike, you see a little bit different. The September 8th, it looks like it has more strikes available than the shorter term, August 21st. So these are how you could compare it within this range, right? This is strike by strike. Doing it by delta, it normalizes a little bit the comparison, because you do have a forward rate, right? So that's taken into consideration other things that the strikes don't. So if the strike on the shorter end is not equivalent to the strike on the longer end because of your cost of carry, right? So you got to take that into consideration by switching to the delta. That's kind of what it's doing. All right. Give you an example. If we take a SPY, right, and we say, okay, well, SPY is 436 right now. Well, there's a carry cost to it, right? There's a forward rate. And if you go out 3 months from now, the interest rate accumulates, and you're really looking at a different strike, a higher strike than today, right? So that's what you're comparing, is how do you normalize the forward rates? So then you're looking at the monies. Okay, so that's why you'd want to compare it to the deltas. So was that helpful with the question?
Yeah, that was helpful. That was real helpful. Sarush and Douglas are talking about SPY 0 DTE puts. Saying Doug is saying their buying has a slight edge.
So buying the 0 DTE puts.
Yeah. Oh, and I mean, I don't know if where Doug is seeing that, or you're seeing that right in front of you, but that was something he mentioned. Sarush does have a question. Where is the section that compares IV and realized volatility for SPY for the last 7 days? Thank you.
The IV versus realized.
Yeah.
Okay. So a couple ways to look at it. Now, if you just wanted to look kind of the implied volatility chart, right? So this is the implied volatility chart, and if we look at the 20-day, so here's a comparison implied volatility chart versus realize. And one thing to consider is, what is the implied volatility telling us? The implied volatility itself is a market prediction of forward volatility, right? So when we look at an implied volatility, it's not telling us what did the volatility of the stock do in the past 20 days. It's telling us this is what the market thinks the next 20 days of volatility is. It's forward looking, right? So if I look at today's implied volatility, right? Today's implied volatility, this is a market-based prediction of forward volatility. That's what it is. Realized volatility, we don't know what the next 20 days is, right? We don't know yet the volatility of the next 20 days. We can see what the market's trying to say, but until it happens, we don't know, right? So what we're doing is comparing the realized volatility of the last 20 days, right? So we're comparing what was the last 20 days versus the market trying to predict the next 20 days to see how far apart is a movement from, so remember, we're comparing last 20 days with the market's prediction, like say for the next 20 days, and how far apart are they? This is what this chart is showing us. The market right now, you can see the IB30 is ticking above the latest 20 days. So what the market is indicating is that they're anticipating volatility to be above the most recent trend. Okay, and then you could see by how much, right? That's what this is showing us. If we want to compare, how did the daily, so the implied volatility changes, right? Daily. Every day we'll see a new implied, just like a stock price, implied volatility can change. Go up, go down. Those market predictors are changing because people are inputting their models, and the new inputs, the new information is creating a new forecast. So how did the daily move? Oh, sorry, got the wrong one. Implied moves. So I'm going to go in the implied moves, and this here is showing us from a different viewpoint, different perspective. And if we take the options, right? If we take the options at the end of the day, and let's say we take the most, so in SPY, we could basically get an option that's predicting the next day's move, right? Because it has the 0 DTs and daily options. So if we take the option at the end of the day and say, if we convert that implied volatility to an actual move, right? What is the market's implied move, right? A one-day move. And then the next day, we could compare it to the actual move and see how much the market error, like how much is the market predictions erroring from the actual. Okay. This is what we're looking at. So on a daily basis, at the end of the day, we look at the option and we say, what is the option predicting for the next day? The range. And then because the options are predicting a range. This is what this bar is, the range, up or down. And then we could say, okay, we have that. Then let's wait the next day and see what the market actually did. And then this chart compares the actual move. So the actual move is in red or green. So the red is saying this is the magnitude of the move to the downside. See the percentage terms. This is the magnitude of the move to the downside, represented in red. If the stock was up, this is the actual move to the upside, right? Because you get a positive return. And if the actual move exceeded the previous day's market predicted move, you'll see that this move went beyond this bar, right? So here I'm hovering over August 15th. The actual move was down 1.2%. Okay, that was the actual move. The markets were predicting a move of 0.7% either up or down. So you could see that move broke through and exceeded the actual move, right? The previous days you could see, or these days you could see the move was within the range, okay, within the band. This is the band. It was within the band, and this gives you a visual of the market's anticipated move versus the actual move, so you could visualize the errors. Now, if we just wanted to see a summary of the errors, we could go down here. So here we kind of just tell you, was it within the band, or did the move exceed the band? Okay, and you can see the actual move versus the implied move. So if the implied move was 0.9%, the actual move was 0.8%, then it was within the band. Okay. And how often did it stay in the last 20 days? So we're looking at like a month's worth, right? 20 trading days. How often did the move stay within the predicted range or exceed the predicted range? So here there's 14 trading days out of the last 20 that the stock move was within the market prediction, right? So here you could see here, right? A lot of these moves were within the market predicted band or implied band. 6 of those days it was outside. So how did the average implied move compare to the average actual move? If we took, well, what was the average error, right? So on average, there's a 0.8% market implied move versus an average of 0.5% actual move, up or down, right? Up or down. So far in the last 20 days, even though we had some big ones that, broke through, you could see here. So far in the last 20 days, the markets overestimated the next day move, right, by 0.3%. And to me, it looks like visually, right? What else can we see? Visually, it looks like to the breakouts were bigger to the downside. So here's a couple to the upside. This one narrowly breached it. This one breached it a little bit, 1% versus 0.8, but to the downside, you could see here points, the actual move 1.4% versus 0.6. There's another big one here, negative 1.2% versus a predicted move 0.7. So far, this is kind of indicating that there's less liquidity to the downside, right, than to the upside. So when it breached, it really, the liquidity to the downside looks like they're backing off, right? That's what it's kind of appearing to me. So we went from, buy the dip to we're not, from this chart, just from this visual, that, that is not the strategy anymore, like buying the dip, because as it's going down, we see some of that liquidity support fade. Okay.
That was awesome.
Yep. All right. We're right up at 9:30, guys. Thank you for the questions.
Yeah, the questions make the show. It's awesome.
Definitely. Everyone have a great weekend. Stay safe out there. We really appreciate you guys joining us and asking questions. And I hope to see you guys on Monday.
All right, everyone have a great trading day.